Okay, we are still in this topic, which is the use of double entry in accounting system. So for today, we are going to focus on ledger accounts. Let's refresh back what is double entry bookkeeping. It is the systematic recording of the financial transaction of a business. It involves the balancing of financing transactions as well as recording them. So the double entry bookkeeping is the standard accounting practice for recording financial transactions. It is based on the concept that every transaction has a dual effect that is therefore entered in two separate accounts. Now, let's look at ledger accounts. Ledger accounts are a series of separate accounts in a ledger. One account is used for each type of transaction. Each account is divided into left-hand side and a right-hand side derived from the dual effect. These are traditionally looked as T account. So this is an example of ledger account that has format T account. At the top here is the name of the account, and this is the left hand side. We call this is the debit side, and at the right hand side this is a credit side. So this debit credit side is derived from dual effect. Each transaction should have debit and credit effect. Now we are going to look at double credit rule. Okay, how the assets equals liability and equity can derive the double credit rule. Okay, as the previous, we have learned that assets equals liability plus equity. So for this equation, we put at zero amount, and the equal side means that at this side, assets become zero, liability becomes zero, equity becomes zero. Then, when the arrow go to the left side, means that asset become, the amount is become increasing and increasing. So the left means that the left side of the asset is increasing. When the amount of asset goes down to the right side, it becomes to zero, it's increasing to zero. So look at this T account. So this T account, we divide this asset part into two parts. One is credit, another one is debit at this asset. Okay, the credit side is at the amount which is decrease this to amount of zero. So when amount increasing, it is at the debit side. So we can say that as the asset increase, it should be recorded at the debit side, and as the amount of asset decrease, it should record as credit side. As for liability and equity, when this arrow go to the left side, so the amount will be increasing. So when it goes to the left side, the amount now decreasing. Same as for the T account, the right hand is the credit side. Since you can see the arrow is increasing amount, so increase in equity and liability you should record in credit side. So if the amount decreasing for equity and liability, you record in debit side. Now let's go to the things that decrease and increasing of equity. As we know before that revenue will increase the equity, expenses and drawing will decrease equity. So this apply in this sheet account. As expenses, drawing for sole trader, DVD is for corporate, will decrease the amount of equity. So you see, when the amount of equity, you will debit this amount. So expenses and drawing or dividend, you should debit this account. As for revenue, this amount will increase the equity as we have learned before. So meaning that any revenue should be recorded as credit side. So we can summarize for this what I have explained to you. For debit side, increase the amount of asset, expenses and drawing, you should debit this account. As the liability, equity and revenue increase, you should credit this account. Same goes for the liabilities, equity and revenue decrease, you debit this account. And as amount of asset and expenses drawing decrease, you credit this account. So in order you to remember this one, this is the increasing amount that should be recorded in debit side, which is assets, expenses and drawing at AED, and this side is the amount that increase that you should credit, which is liability, equity and revenue. So you can summarize this as at look. So AA for asset, E for expenses, D for drawing, which is debit side, one is increase. For liability, equity and revenue, if this increase, you should credit. Now let's go to example. Let's say M contribute $10,000 as capital. So how to record this one? So the effect for account, the first one is $10,000. This is cash and this is capital account. So you have cash account, capital account. So when contribute to the business will increase with the 10,000. So you should debit cash with the 10,000. The description here is the opposite account, which is capital. This cash come from the owner as capital. So this is the opposite side, which is capital. So we go to the capital. So this is increase, you debit, and the capital also increase in a business. So you should credit the capital account with cash with 10,000 also. So the description here is the opposite account, which is cash. Next, buys a computer for $5,000 cash. Again, this involves cash account and computer. Computer is the computer equipment, falls under computer equipment. So the cash now pay off. It will decrease the cash. So it should credit cash account with the 5,000. So the opposite account, the dual effect is the computer equipment. So the computer equipment will increase in a business. So you should debit because computer equipment is an asset. Here the 5,000, so the description here is cash, the opposite account. And borrows 5,000 from the bank. When a business borrows 5,000 from the bank, so it will increase cash for a business. So the cash account will increase, it should be debited. Where the cash come from? From loan. So the loan account now exists in this business and increase the amount of 5,000. So loan is liability, it should be credited. Loan account with 5,000 and description here is the cash, the opposite account. Next, buys a printer for 3,000. Again, the account is printer and cash. Printer is computer equipment. Just put in one account for things that are related with computer. So, since you buy another printer, business buy another computer, some things that are related with the computer, so we'll increase the computer equipment by 3,000. And also, the cash used to pay off, so the cash is decreasing, so it should be credit cash by 3,000 and the account should be debited is the computer equipment. So at the computer equipment, you debit again with 3,000 because it increased computer equipment in a business. Next, repay loans to the bank. When this company repay loans to the bank, the cash will decrease. So the cash account, which is asset, should be credited with the 5,000. So the other effect of the account is the loan. So the loan has been paid. So the loan amount is decreased. The liability, when decreased, it should be debited. Now is debit 5,000 for the loan, so the cash now, the description is the opposite account. Now the company purchased tracksuit for resale for 5,000, so this company is doing trading on sport equipment. So this one will affect purchases. So purchases is an expenses that will decrease the equity. So you record debit for purchases. So since you buy by cash, the cash will decrease. So you credit the cash and you will debit for the purchases because purchases will decrease the equity. So you know that it should be debited 1,000. So this one should be to write down the effect for the other account. And that is that pay rent 5,000. When the company pays rent, so the cash will decrease. So again, credit cash with 1,000 because of the rent. So this one, the rent now this rent is an expenses, so it should be debited with 1,000 cash. And lastly, sells all tracksuit for 5,000 cash. So when the company sells a good, so the company will receive cash. So it will increase cash at cash account. So debit for the cash account 5,000 because of sale. So the sales amount, this is revenue that will increase the equity. So you credit this account 5,000 and the description is the cash that received. So this is the account that being recorded for this 8 transactions. At the end of the month, we should close the account by balancing the account. Balancing the account is the first step in making sure that the double entries have been recorded correctly. So the procedure is, this is the cash account that we have recorded before. First, cash the debit side and note the total. Same for the credit side, note the total. So for the cash for debit side, the total is 20. Just note down. And then for credit side, the total is 15,000 in note it here. Just note down. And then whichever is larger will be total on both sides. Write this in. So you have this balance for this column. So you just take the bigger number, which is 20,000. So you put 20 for the debit and also for the credit. Now you look at here for the debit side. Insert the balancing figure so that the both sides are equal. So now you look at here, this is 20,000 enough, but here we only have 15,000. So it's not enough with the 5,000. You just add 5,000 here as balance carried down. This is the enough the balancing figure. Balance carried down is the balancing figure. This is forward in time or the balance carried down. You can say write down CD or CF, carried forward. So this is balance at this time only as for the balancing. You cannot say this is a closing balance. This is the balancing figure. So if the sum of debit exceeds the sum of credit, let's say this is 20 and this is 15,000, so this is more. So means that the closing balance should be the debit side because this is more. So the balance BD brought down is 5,000. So this is the closing balance. So if the question asks what is the closing balance for cash account, is 5,000 debit. Same goal, if this amount is more in credit side, so the balance should be credit balance. So this one, the balance CD is the only the balancing figure. This is the rest of account that has been balanced. You can see that capital has the credit balance. The nature of capital increase is credit. So the balance brought down, the closing balance should be credit. This is rent, expenses. Expenses is debit, increasing the expenses debit. So the balance should be at debit side. Same goes for equipment. This is asset, increase asset, more in debit. So the balance is debit. Same for sales, revenue. Revenue increase is in credit side, so the balance is credit side. For the loan, you can see that this is the amount equal in debit credit side, so there is no balance. For purchases increase in equity in debit side, so the closing balance is at debit side. So this is closing balance at the end of the month. The next month become the opening balance for the next month. Okay, this is for assets and equity liability should be reported in statement of financial position, whereas for expenditure and revenue should be reported in statement of profit or loss. So whatever reported in the statement of profit or loss is the nominal account. This account will bring forward the balance up to the end of the accounting year. After accounting year, all the revenue expenses will transfer to statement of profit or loss, and all account becomes zero. So the next accounting year, we will start with the new amount. After that, after we have balance of the account, now we need to extract all the amount closing balance to the trial balance. So we extracting a list of balances in a trial balance. So ledger balance can be extracted or listed at any time, whether amount at any time. Always extracted at the accounting year and prepare financial statement. So the purpose is to prepare for financial statement. The list of balances also known as trial balance. So all the list of balances you just list down in a trial balance, a list of debit and credit balances on the individual ledger account. So we have two formats. One is a T account, so this is credit side. All the credit balance should be credit side, all the debit side balance at the debit side. You can see this one, total for debit is 15,000, total for credit is 15,000. So double entry rule has been performed here because it is the amount for debit and credit is $15,000. So the trial balance will detect the double entry error. So this is another way to write the trial balance with in column side by side, and all the item here, the count here. So again, this is a debit side, this is credit side. The amount should be equal 15 and 15. Now we close the book by transferring all the balances to a statement, which is statement profit or loss, statement of financial position. So all the income and expenses should go to statement of profit or loss, and this account should transfer to statement of profit or loss for the period. So then this account should be zero. Next account started with the new amount. Okay. For the trading, you already know that for statement of profit or loss, we have two parts. One is trading, one is the income and expenses. So for the trading, you can get the gross profit, and if the credit asset debit, then the balancing figure represent profit and is credited to return earning. Return earning is for the company that you will learn next semester. So, but for sole trader, when the credit exceeds the debit, so this is the company will get profit, and the profit will be transferred to statement of financial position, and this will increase the capital of the owner, sole trader. If the debit exceeds credit, so the company will suffer loss. So this is all the expenses account that will be zeroized at the end of accounting year, because it goes to the statement of profit or loss. The next accounting year we start another amount. So for asset and liability accounts are left with balances, as we know that for assets and liabilities and equity, the balance that should be reported in statement of financial position. So this balance should be carried to another accounting period. So this to show the statement of the position of the business. So from the previous example, you can say sale is 5,000, cost of sale is 1,000, opening 0, purchases 1,000, closing 0. So opening plus purchases minus closing inventory, cost of sale is 1,000. So the sales minus the cost of sale, you get gross profit of 4,000. So less another expenses will relate to operating of the business is rent 1,000. So the net profit is 3,000. So this 3,000 you will transfer to this account, this statement of financial position. So the first part is non-current account, is the equipment. We have computer equipment. The balance is 8,000. And the current asset we have cash. The cash previously we have 5,000. So the total asset is 13,000. As for equity, we started with 10,000, and the net profit here we transfer to the equity 3,000. So 13,000 because the loan paid already, no balance. So just left equity side only the 13,000, which is equal to the total asset 13,000. So this is a topic related with the ledger account. So for the ledger account, you will do a lot of work, starting with the report in the ledger account, and then balancing the account, and then you close the account, transfer all the balance to the trial balance. From the trial balance, you prepare the statement of financial position and statement of profit or loss.